What if you could generate consistent cash flow every single month, no matter what the market does? In this video, we break down one of the most powerful and underutilized income strategies in options trading, the call diagonal. We'll walk you through a real campaign that produced 1,000 in realized profits over 4 months using just $11,000 in capital. Whether the stock went up, down, or sideways, the trade still paid. I'm Mike Bellafiore, co-founder of SME Capital, one of the top proprietary trading firms in New York City since 2005, and now in Miami. We've developed and backed some of the best options traders in the game. Stick around as we teach you how this strategy works and how you can use it to build reliable monthly income from your trading.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And probably the most common question that we're asked as a proprietary trading firm is whether it's possible to make a living trading options. And if it is possible, how can you make that happen? And so today's video is intended to answer that exact question. And so if you're interested in whether it's really possible to earn a living trading options, then stick around, because I think that you're going to find this encouraging. Because in fact, it's not that difficult if you know a thing or two about options trading. Now, before we get into the option strategy that many professional and retail options traders use to make a living, if you're absolutely brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we'll be sharing with you in this video. Then when you're finished, you can come back and watch the rest of the video. The best way to jump into the strategy I'm talking about for providing a flow of income from options trading is for us to take a look at a chart of the iShares 20-year Treasury bond ETF known as TLT, which is basically a proxy for the long-term U.S. Treasury bond market. And as you can see, with the uncertainty around the direction of inflation and therefore Fed policy, the ETF has been selling off steadily since September 2024. And by the third Friday in January 2025, January 17th, the ETF had closed at 87.19, down significantly from its mid-September recent highs. And we intentionally selected the third Friday of January because, as some of you may know, almost all stocks and indexes have an options chain that expires on the third Friday of every month. And so you can reliably conduct monthly campaigns of trading the same basic option strategy, rolling your capital over each month on or around the third Friday of each month, and it should work out very smoothly. And so let's pull up the options chain that expires about a month later on the third Friday of February, which is February 21st. And let's locate a call option that's very slightly out of the money, the 88 call option, which is about 80 cents above where the stock closed. And let's go ahead and sell 10 of those for $1.18. And then let's move all the way to January of the next year, 2026, and we'll go far below where the stock's trading, down at the 76 call option strike price, and we'll buy 10 of those for a price of $12.55. And so when we do this, buying an option expiring well into the future and simultaneously selling a call option expiring sooner than that at a different strike price, then we are executing what options traders refer to as a call diagonal. And it's a strategy that can be utilized to create cash income every month for traders looking to trade for a living. Let's take a look at the cost of this trade so you'll understand how much capital you'll need to conduct a campaign like this. And so starting with the 10 calls expiring in January of 2026, as you can see, they cost $12.55 a piece. But remember, each call option represents the right to buy 100 shares of a stock. And so you multiply that price by 100, and you bought 10 of them. And so multiplying it all together, you can see that you'd spend $12,550 to buy those January 2026 calls. But then you also sold those 88 calls expiring in February of the previous year, 2025, for $1,180. And so that resulted in cash income of $1,180. And so that reduces your cost, and thus the net cost of the initial trade is $11,370, as you can see from the calculation. Okay, so now let's move to the day that the short calls we sold expired, which is February 21st, as we mentioned earlier. And as you can see, TLT had staged a mild rally since we put the trade on January 17th, closing at 89.61 that day, February 21st. And so, what is the outcome of this trade? Well, let's first take a look at the 76 calls we bought a month earlier when TLT was trading lower. And as you can see, those calls have increased in value to $14.52 from the original price of $12.58, which makes sense, right? Because the right to buy TLT shares at a price of 76 when they're trading for 89.59 is certainly a right, which is worth a lot more than when they were trading at 87.19, the original price that TLT was trading at on the day this trade started. In other words, the higher TLT goes, the more valuable that 76 call is going to become, because as TLT's price increases, the discount you're getting on the shares of TLT by having the right to buy them at 76 gets larger and larger, and thus the option is worth more. And when we turn to the short options that we sold using the February expiration, well, those closed at a value of $1.60. Why? Because those options expire that day. And so the exact value of those options is finalized because the option's expiring. And so the options price will be almost exactly the difference between the closing price of TLT and the call option strike price. In other words, all of the extrinsic premium has evaporated from the options, and therefore the options value reflects purely its intrinsic value. And so when we look at the conclusion of the trade, you can see that selling off the long calls yielded us $14,520, while buying back the short calls cost us $1,600. And then deducting out the original cost of the trade, the result is a profit of $1,550, which is a yield of 13.6% in a little bit over a month, which is pretty good. Okay, so with campaign-style trading strategies like the monthly call diagonal, you do your best to replicate the previous trade and just basically reproduce it for the upcoming month. So we'll go ahead, just like we did last time, and sell 10 of the calls located at the first strike price above the closing price, 89.61, which is the 90 strike. And we do that using the March 21 options chain, again, about a month out, using, again, the third Friday of the month for a price of $1.13, very close to the price we received last time for the short calls. And then we move down again about 11 points below that strike price, just like we did in the previous example, buying this time the 78 calls expiring January of 2026, which cost this time $12.85, which is a slight bit more than we paid last time. So both prices are close to the previous prices, and that's not an accident. We're trying to make everything as apples for apples as possible here. And so this diagonal is slightly more expensive at $11,720, but fairly close to the previous cost because, again, we're trying to keep things consistent whenever we run a campaign like this for income. And so moving to the expiration of the March trade, we can again see that TLT mildly rallied, closing at 90.70 on expiration day, March 21st. And so again, TLT rallied past the call strike price location at 90. And so when we look at the final price of the 90 call on the day it expired, it makes sense that it closed at a price of 69 cents, because that is almost exactly the difference between the 90.70 closing price of TLT and the 90 strike price of the calls. And the long calls expiring in January of 2026 also appreciate to 13.57, resulting in a final trade profit of 11.60. And so we'll move finally to the April expiration, setting it up exactly the same way, selling 10 short calls located right above TLT's closing price. So that's the 91 calls selling for $1.16, and 10 long calls expiring in January of 2026, again about 11 points below that at the 80 strike price for $11.93. And so the net price of the diagonal trade this time is $10,770, a bit less than the previous trades, but in the same basic ballpark. But this time we have a different outcome, because this time TLT sold off, closing at 87.53. And so what is going to happen to those short calls at the 91 strike price? Well, those are going to expire worthless. right? Because there's no value to an option to buy TLT at 91 when it's trading at 87.53, and so that option expires worthless, resulting in a realized gain of all of the call premium, 1160. Now, of course, the long calls went down also with the stock going down, and those closed at 982 that day. But here's the important point. Whenever this happens in a diagonal campaign like this, whenever the stock goes down and the short calls expire worthless, then we simply don't sell the long calls like we did in the previous ones. Rather, we hold on to those long calls and then sell the next month's calls at the same strike price repeatedly if necessary, if the stock stalls out for a while, until a month where the short calls expire in the money, like in those first two examples. If that happens, the price of the long calls will recover and the entire diagonal that month can be sold for a profit. And so if we compile the realized gains from all 3 months that we looked at, you can see the total realized gains tallied up to 3870 on average capital of 11,287, and each month yielded realized gains of over $1,000. And so what I'd like you to take away from today's video is that options traders have sophisticated ways of producing cash income each month, and the diagonal, which in reality is a variation of a covered call trade, is one of the most capital efficient methods for producing monthly income using options. Now, there will be occasions like the April trade that we just showed you where you'll only be able to produce a realized gain for half of the trade, the short calls expiring worthless. But the solution is simple, and that is to continue to sell calls at the same strike price month after month, and eventually the stock will rally, the short calls will close in the money, and the entire diagonal can be sold off for a profit at that point. And so if you think about it, every month is absolutely certain to produce some cash income, either by taking the realized gains on the short calls expiring worthless or selling the whole diagonal at a profit. And so that's the beauty of options trading at a professional level. There are strategies such as the diagonal where you can produce a realized gain every month, one way or another, and this same strategy is available to any retail options trader as well.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.